Financial experts have always maintained that keeping a diversified portfolio with investments spread across varying asset classes and securities is sacrosanct. Diversification ensures that your portfolio's risk do not get concentrated because of lopsided asset allocation. Now, decoding the right balance between risk and reward can be a game changer in your investment journey, and maintaining that balance is a constant process. Now, both these variables undergo changes at different stages of life and are closely interlinked with circumstances, including your income and your goals. However, finding the right diversification formula can seem like a complicated puzzle. It is common for investors, especially those new to the game, to either over diversify their portfolio or give too much weightage to their preferred asset classes. Now, this is where hybrid funds can plug the gap. These are a category of mutual funds that have a debt component and an equity component in a specific ratio. Now, these funds provide diversification and can act as a cushion against risks posed by asset concentration, with the investment being spread across two or more asset classes. Now, if you're struggling to find that elusive proportion between asset classes of varying risk levels, hybrid funds can be the right fit for you. I'm your host Gautam Srinivasan, and today in this special presentation from Mint, we'll take a deep dive into the gamut of hybrid funds and hear from the experts on how their addition to your portfolio can be advantageous. Joining me on the panel are Swarup Mohanty, Director and CEO of Mirae Asset Investment Managers India Pvt. Limited, Yasir Varawala, Director of Abacus Corporation, and Arun Kumar, Head of Research at Funds India. Gentlemen, great to have you on board to help us all understand more about the world of hybrid funds. Let's start by looking at the charts for the market, Swarup. Swarup, it's been quite an eventful journey from the March lows of 2020 of sub 26,000 to over 60,000 in closing, hit a few days ago for the Sensex, and of course over doubling of fortunes for the Nifty as well during that period. Now, not every investor might have participated in the hybrid funds journey during this time. What would they have missed out on during this period?
Actually, the hybrid funds are a very interesting bunch of funds where, it's a classification of 6 different funds, and they stand very good on the merit of their fund, specifically on the way they are managed on both equity and debt, and sometimes they are multi-asset. Invariably in the past, we've seen that the merit of the allocation of the portfolio is not looked at, and that is reflected on the flows that are seen. And especially in buoyant markets like this, one works completely to the buoyant asset class, which is equity. So sometimes in buoyant times like this, the merit of these products gets missed a bit. But what I really appreciate about the hybrid funds across the various types of hybrid funds, that they are very solid in structure, and something which we'd like to discuss today, because they range from the equity savings, which is low in equity, to the aggressive hybrid, which is high in equity, and it caters to every type of investor, and that's something which has to be kept in mind. And the whole objective of investing is to marrying your investment objective with the fund's objective. And in the hybrid category, there is a fund for every investor.
All right, a flavor for every investor, a product for every investor. We'll expand on that and understand what are the categories and what are the profiles of investors they are suited to. But dialing back to the conversation we're having, Yasir, your response: where does risk-taking appetite or lack of importance given to asset allocation feature in this context of not taking the hybrid funds route during the time markets are soaring?
Yeah, Gautam, first of all, thanks for having me here. And, particularly on this point regarding the lows of March 2020, reaching up to, say, the recent past, or let's say yesterday, definitely I think investors have missed out this particular space. And if you want to, think about what was the reason, was it lack of risk appetite, or lack of asset allocation? I think it would be a mix of both. Now, if you go back to March 20, we all know that, the pandemic was before us, shaken all of us. We didn't know what was coming forth, lockdowns, people losing jobs, sad stories, and I would say it was a very depressing kind of a situation, not knowing what the future holds for you. So I think the first reaction of most of the investors was to de-risk, or get risk averse. And I think many of them decided to either switch out totally, some switched to certain debt funds, some switched to liquid, or they just went out. So I think that initial phase was a lot to do with the risk-taking appetite, like you have just put it. And there were very few who really had seen such cycles before and decided to hang on and say, okay, things could be normal. But we have even heard of investors who have been through cycles and yet they decided to move out of the markets. So ideally what should have happened is that probably they should have not moved out entirely, but maybe de-risked a bit by coming into one of these six categories that six schemes that you have within this hybrid category. So I think that was the first initial part of the whole pandemic when it started. And then to add to all of that, even the experts didn't know what was happening. And, there were a lot of Zoom calls and a lot of media coverage where people were saying, you need to be cautious and over a period of time. And then you came across a phase where markets were doing something which one did not want to believe or one couldn't comprehend, I would say. Okay, why is this happening? Even today, questions are raised. Why is the market at a level when the economy is somewhere else? So then I think.
And what about the lack of priority with regards to asset allocation? How much was that a driver?
Yes, I think in the next phase when markets started doing well and people started realizing that it's better to be at least participating in the market, then I think this asset allocation played a part, or lack of asset allocation really played a part. And many investors and probably new investors also flocked to the pure equity schemes like Swarup was mentioning, because obviously the returns were far higher. And the entire category was probably missed out by everybody. Now, if you see, I was just trying to do some data crunching, and the aggressive hybrid category had an AUM of about 1 lakh crores in March. And till August, it was 1,40,000 crores. So, there is no real addition. In fact, I would believe there's a net outflow because the markets have done better than that, even considering that it has only 65% or 70% equity. So surely people have missed this whole piece of the hybrid space. Either they flock with probably the fear of missing out or whatever it is, and looking at past returns and short-term returns, and they've all flocked to the equity category when they've re-entered, or the new investors who have entered the markets for the first time. So I suppose it's a mix of both, actually.
All right. Well, what's past is past. Let's look toward the future and understand the use cases where hybrid funds fit in a portfolio. Arun, there are 6 categories within the hybrid fund segment as per the SEBI classification. Now, all of them offer a rather differentiated investment proposition, from aggressive, conservative, and balanced to balanced advantage, multi-asset, and arbitrage. So, how should investors decide which is the right type of hybrid fund product for them in the context of the mix of debt and equity linked instruments within them?
Yeah, thanks, Gautam, for inviting us to the show. So broadly, if you really look at the category, obviously, as you said, there are 6 different subcategories within the common hybrid tag. So the simplest one is the arbitrage fund category. Now, it is classified under the hybrid bucket because there's a mix of arbitrage and debt funds. But from a very practical point of view, most investors look at it as a debt kind of a category. Because if you really look at the 6-month or a 1-year kind of a time frame for this category, more or less the returns kind of are very close to liquid funds, while the volatility is a little higher on the 1 month or a weekly basis. But over a 6-month, 1-year period, these funds give you returns more or less similar to liquid funds. So more or less, it's considered to be like a very similar to debt. The reason why people prefer this is because of the taxation advantage. Because after a year, this category is taxed at gets the equity taxation. So for people with maybe 1.5 years and at the highest tax bracket, this sometimes makes a lot of sense, because given the taxation differential between a debt fund within the time span of 1 to 1.5 years. So that's how we would look at the arbitrage category. fairly simple category. You have a 1 to 1.5 year time frame. You want the taxation advantage, and you want a liquid plus or minus 0.5% kind of a return profile. So that's probably at the bottom end in terms of risk profile. And then the other categories are where you really get the proper mix of debt and equity. And obviously there's the multi-asset category where you get the third asset class in terms of gold. But pretty much all the other categories, you normally tend to see a mix of equity and debt. And generally, the higher the equity, the higher is the return potential. But at the same time, you also get higher intermittent declines for that particular segment. And hence, the broad concept of the hybrid category is that there's one asset class which gives me longer term returns but is volatile. There's the other debt asset class which gives me lower returns over long run, relatively inflation plus kind of a return, but is far more stable. So however I combine, I get to do different solutions. So if you start with the bottommost, I think would be the conservative hybrid category, where you have close to around, let's say 20%, 25% is the range at which most mutual funds have their equity exposure. So it's fairly a good starting point for somebody trying to move up the ladder from, let's say, FDs, because you're getting some bit of equity exposure, but it's not too high that the volatility will kind of become too much of a surprise for you. And then if you want to slightly increase your risk profile and you want to go slightly up, then you go to the equity savings category, where you generally, the industry runs at around 30% to 40% in equity allocation. So this is slightly slight higher risk than the conservative. And then you have the aggressive hybrid, which is close to around roughly maintained around 70% equity. So this is for people with slightly longer time frames. They understand equity, but they don't want to go all in. They just want to try out equity at 70%. And then you have an interesting category called balanced advantage fund, where essentially they say that I'll manage your equity allocation in different ranges. So again, different mutual funds have different ranges, but roughly it's between 0 to 100%. So based on some valuation parameter or momentum. So every fund house has its own model, but this is again, this is probably in between equity savings and an aggressive hybrid fund. So net, you can assume this fund to sometimes play like an equity savings, sometimes become like an aggressive hybrid. It's a mix of all these three categories that we are talking about. The last category would be the multi-asset allocation category. It's not a generic category because each and every fund house has a different variation of how they are interpreting this. So very difficult to paint the entire category with the same brush. So we'll have to look at each and every fund in terms of what is their strategy and how they. But I think the other 5 categories are fairly simple, and we have to be a little more cognizant that the last category alone has its own nuances in terms of each and every fund. So that's how we would broadly see this bucket of hybrid funds.
All right, that's quite a comprehensive explanation. And considering, Yasir, you touched upon this, considering the galaxy of options on offer, does it surprise you that folks missed out on the hybrid fund story? You know, I'd like to understand from you, from your perspective, the use cases where hybrid funds fit in a portfolio from here on. Let's assume that, well, people have come to their senses and they want to approach hybrid funds as an option. Where do they go from here?
So, so as Arun pointed out, you have a total platter in front of you. You choose what you want, and obviously you choose keeping in mind your risk appetite, your time that you can, the time horizon that you can give your investments to remain invested. Another important factor would be the cash flow requirements, I would sense, other than the risk appetite and the investment horizon. A lot of investors need regular cash flows coming to them. And if you see these investors, some of them who have migrated from the fixed deposit category, so to say, who are getting the quarterly interest, etc., and you migrate them slowly into these conservative and etc., you move up the ladder, they yet require the cash flows coming to them. So depending upon the amount of cash flow they required, relative to the amount they've invested. So, if you've invested 100 and you say, I need 10 every year, now that's a little tough, right? You're probably eating out of your capital. But so relative to that, depending upon the investor's need for cash flow, I think all that would then decide which particular fund he would fit into, which particular subcategory, so to say, he would fit into.
All right, the cash flow use case for determining the product that you would choose when it comes to hybrid funds. Valid point there. Arun, coming to you and expanding a bit more on the tax implications which you spoke about. We hear investors or advisors talking about deciding asset allocation on their own. While it has its merits, is there any tax implications one needs to watch out for? And how does hybrid fund make investments tax efficient?
Yeah. So broadly, if you really look at it, there are two choices, right? One is all these hybrids are net the fund house trying to bring together different allocations. The obvious choice is that you can also replicate it on your own, and obviously that gives you a lot of choices in terms of what all equity funds can I participate in, what all debt funds can I participate in. While this works great, the only thing that we'll also have to realize is that both these asset classes do not perform equally well, right? At some point in time, equities are disproportionately giving you higher returns, and when there is a fall, equities might disproportionately do relatively lower compared to debt funds. So what happens is that while you start with, let's say, a 70% equity and a 30% debt allocation, you will find that as equity markets go up and down, your allocation ranges don't stay static. So sometimes you might end up at 80 while you started with 70. So this requires a simple act called rebalancing, which is nothing but when my allocation from 70 becomes 80, normally you keep a band, let's say plus or minus 5%, because otherwise there's a tax implication. Let's say it goes to 71 and then I again want to cut it back, then I have to sell some bit of equity. It might be under the 1 year exit load period, or it might incur based on the timing of when you bought the fund and when this happens. So usually what people generally do is they give a plus or minus 5% back. But if it goes over and above beyond that, you don't want to let it run, because at some point in time, it might, what started off as 70 might end up at 80, 85, 90 if left unaddressed. So what generally is being done is that you try something called rebalancing, where you reduce the equity allocation back to your 70%. And it can be the other way. When markets fall sharply, instead of 70, you might be at 55. So then again, you get it back to 70. So both these will require you either to sell equity, buy debt, or sell debt and buy equity. Now, there's a taxation angle to it, especially if you're selling debt, because there's a 3-year taxation period below which you get only the short-term capital gains. And so there is always an inherent tendency to delay this decision, because you're like, let the taxation period. And by then you realize that the markets have already started. So what happens is that while ideally it is better to do it without thinking too much on this, but these taxes are a little bit of add a lot of friction, and sometimes people delay these decisions. So hybrid solves for this, because net you don't incur these taxation, because it's done at the fund house level. As an investor, you don't need to worry about the tax. So as long as you don't sell the fund, and whatever allocation you've chosen based on the hybrid spectrum that you've chosen, hybrid category that you've chosen, you will be able to maintain the same allocation, and it's more like a fillet shuttered kind of a product. And as long as you spread it out across, let's say, 3 or 4 different fund houses, and you don't want to be involved in this rebalancing process, this works fine. So I think this is the major taxation advantage for a complete fill it, forget it, and let it run kind of an advisor, kind of an investor. The other small nuance is that you also have to remember that for certain categories, let's say like a conservative hybrid, there is a small equity portion, and the whole category might be looked at as a debt taxation, so that your 25% or whatever, 20-25% might also be taxed as a debt component. So that might be a disadvantage. But the same thing flips on the other side, where for an aggressive hybrid category, the 25-30% debt you have will get the equity debt. So there are nuances to it, but broadly, the rebalancing part is taken care without the taxation issue, and it's more or less automated by the hybrid fund. And second leg is there are some nuances which you may also have to, it may or may not be an advantage, depending on which category that you're choosing. So that's the broad way in which we would like to look at this.
Sure, that's the tax efficiency overview for different categories of hybrid funds. But to boil it down to a single point on, what do new investors do? Yasir, I'll come to you for this. Do you think hybrid funds are a good fit for new investors? And if so, why is that?
Yeah, I think surely they are. Like, we just spoke, a lot of new investors are the ones who are migrating, from fixed income, or let's say fixed deposits, more conservative products. And first time they're really getting into something which is market linked, be it the equity side or even the debt side, and that could create some kind of shock for anybody. So, there are two kinds of new investors, in my opinion. One is those who are sitting on the fence and waiting, so, and probably they miss the bus. So definitely this is a good entry point. You start, and then as and when you get comfortable, you start moving up the ladder of the risk. You start earning returns which are far better post-tax, and real returns, you beat inflation also. So that's one side. So for them, I think it's fantastic. On the other side, I think probably what we've seen in the last few months, there are a lot of new investors, scores of new folios being added, new unique investors coming into the thing, and you realize that most of them are straight into those funds which have given near-term past returns near-term. And obviously those would be the pure equity funds. And if at all they go into a bad cycle, they'll probably never come back. And their whole scheme of things where they decided to save, invest, build wealth creation, it would just stop. And so that would be a disaster, I think. So definitely for new investors, I think this on either side, whether you're too aggressive or you are too conservative, this is a good start. And then you build yourself up as and when you experience it. If you have a good experience, you move up the ladder. If you don't, you stick to it, because anyway you're supposed to get better returns than the bank fixed deposits in it. That's how it's all made. So I would say that it would give a very smooth entry and a smooth initial passage in the investing in the funds or in the market linked instruments, rather than having a roller coaster ride and getting him out of this space forever.
Absolutely. Kind of like training wheels on a cycle. It allows you that stability to be more confident in the market and figure out your investment goals, and then deploy it smartly, deploy your resources smartly. And considering hybrid funds offer a galaxy of options for differentiated profile of investors, you're right, Yasir, it offers them the option that they want to take, which they feel fits their investment profile. Arun, any thoughts to add to this on hybrid funds as a fit for new investors?
Yeah, I tend to agree with Yasir that this more or less this is a very good entry product where like you just want to try out market, because for a lot of them are FD investors, and it's a fairly simple instrument where very stable and you know what to expect from that. But this is volatility as a concept is a little difficult to intuitively get it. So I think this whole gamut of hybrid funds give you the perfect stepping stone. So you try it out with probably the equity savings or the conservative hybrid, and then once you get comfortable with how it works, maybe you go up to the balanced advantage category or maybe the aggressive hybrid. Then once you get a fair sense of how this whole thing works, and probably you see the whole cycle in terms of thankfully we've seen the entire cycle in the last 2 years. You've had a 40% fall, you've had a 150% kind of a rise. So somebody looks through this and then gets it, and then they're also comfortable. So I think it's a fairly good way to start it off, and then they can take a call. Maybe after 5 to 7 years, they'll get a fair sense of how this works, and then they can take a call saying, "Hey, does this work, or should I do it on my own and then build it?" But I think this is a fairly good category to start, and then outsource the entire headache to the fund managers, and then relax and then get done with life. And yeah, some people like complexity, but I'm just saying that take the first 5-7 years, outsource it, and then decide whether it's worth spending your time on this.
Leave it to the experts and then become the expert. Let me come to the expert here. Swarup, the value of hybrid funds for new investors, your point of view on that. And also, what kind of time horizon, long, medium or short, is best suited for hybrid funds? If you could give us the highlights on both of those questions.
I think both Arun and Yasir have said the right things. I just wanted to add the mutual fund side to it. When you come from a fixed income kind of an investment background to a mutual fund is a pass-through vehicle, and it passes back the market returns to the investors. And then markets are volatile because that's how markets are, any market. And then it's a very good entry point for investors, because one has to get accustomed to the volatility, and then over the years understand that in volatility lies the opportunity. right? That is a great position for the hybrids funds to come in for an investor and make the investor not only used to both the asset classes, that is the debt and equity, but also acclimatize yourself to the volatility of the capital markets, and over a period of time, like Arun said, then graduate to becoming a better investor. So it's the first point for new investors. It's a great first point because it gives you this gamut of choice, whether you want to be low in equity or high in equity, and then graduate. And the number two thing is, if you look at it from a taxation perspective, it's very interesting to look at it this way, because in India, we say that long term is debt and short term in equity is when you look at it from a taxation perspective. We're probably the only country where equity long term capital gains start at 1 year and debt starts for 3 years for whatever reason. So I would put the starting point for investments, because investments should be looked at post tax, to be at 3 years, and then along with your investment horizon, match the fund investment horizon. But to start with, it should be 3 years onwards.
All right. Arun, Yasir, any other things that investors should consider before choosing a hybrid fund? Anything in your view we might have missed out on? Yasir, anything to add?
Not really, Gautam. I think we've all covered the major part of it, and most of it will be repetition now.
All right. So we spoke about new investors. Let's look at retired investors as well, Swarup. What's your take on SWP from aggressive hybrid funds? Is it, say, beneficial for retired investors? What would you have to say?
I'm very happy, Gautam, that you're asking this question, because the bane of aggressive hybrid funds has been this segment. Earlier it was sold as a monthly income solution to a lot of investors. And that's probably why this category has gone out of favor due to no fault of the underlying fund itself. But I have failed to understand why the SWP route has not been explored more. It is a far more tax efficient mode, number one. Number two, when you are looking at post-retirement as an investor, you would want a certain amount to come back to you in a fixed note, depending on your cash flows. While when you take the monthly income route or the dividend route, then you are at the mercy of the dividend which the fund sort of declares, and that is never consistent. So if you took the SWP route through a calculated manner, you would be in control of the inflows that you would have or you would want. You can match that. So I would be a big proponent of the SWP route in the hybrid route. The only caveat being, first let the fund appreciate a bit and then start your SWP. I think Arun and Yasir Bhai would be better people as to telling you how long that period will be. But keep in mind that if you start your SIP on your SWP on the first day, then you would be taking home a part of your own capital. So let the fund grow to a level and then start your SWP. In that way, you can plan your SWPs far better.
Absolutely. Give time for the sapling to grow into a tree. And what about static asset allocation versus dynamic asset allocation, Swarup? As we wrap up this conversation, I want to understand your view on, why do you believe static asset allocation is better than dynamic asset allocation? Let's get the highlights from you first.
I think two things. One is, when you invest in any asset class, you would like to get the high of that asset class or the growth of that asset class. That you get if you remain invested in that asset class. And that is what static asset allocation brings. It brings to the element that it will remain invested in that asset class. When you look at a dynamic asset class, it invariably tries to time the peak of the asset class. And that is very difficult to time. All of us know that it is impossible to time the market. But yes, the lure of the ability to time it is always very romantic. It invariably flatters to deceive. Look at what's happened in the last 1 year. And it's impossible to time the market. And as you get into the zone when the market tries to reach the new peaks, invariably it is impossible to know what is the next peak. So the investor who stayed invested over a period of time has got the true value of the asset class. So I am a big proponent of static allocation over dynamic asset allocation. The other part is, every asset class has its own journey. Debt has its own journey and equity has its own journey. You can fluctuate your asset allocation as per your own risk profile, but then you have to stay invested in both the assets to gain the best of both worlds. What the aggressive hybrid does is just that. it has a definite journey for both equity and debt. While in a dynamic asset allocation, the equity is your number one asset class and the debt sort of follows the action of the equity, right? While another powerful thing which Arun pointed out is the rebalance part of the portfolio. The power which a rebalance part brings to your wealth creation is pretty phenomenal, because the rebalance part aims at your asset allocation grid. Suppose we are talking about 75-25 as your asset allocation grid, and your assets grow to 80% in equity, as Arun was mentioning, it brings it back to 75%, which is a doable. Unlike the dynamic asset allocation, which aims at getting the peak of the market, which is invariably not possible. So from ascertaining what is a doable, what can be a more effective way, and gaining the top of an asset as a class, the static allocation invariably gives you the best of all worlds. And that is why the static allocated funds over a period of time get the best of the asset class rather than somebody who tries to time that asset class.
Swarup, if you could expand on the point that you mentioned on static asset allocation being better than dynamic asset allocation, if you could provide more details to our viewers, that would help them come to a better decision. So I'll let you take it over from here.
Yeah, thank you, Gautam. It's been a very interesting debate, static versus dynamic asset allocation. Like I explained, it's always very romantic to believe in the thought that tomorrow the market will tank and I know today I can exit. It's easier said than done. When you look at the dynamic asset allocation funds, and this is not for or against both, I'm just trying to put both the perspectives in front of the investor. And what it does, it tries to find the peaks of the market, be it from a valuation perspective, be it from a level perspective, and then, alongside that, time the equity allocation. It does try to peak its equity allocation along with the peak of the market. But over a period of time, if you've seen the allocation of the industry, it has been very difficult to sort of time it, because when you look at it from a P perspective and you look at the market and you say, suppose just for example, say 30x of the market is expensive, 24% of the time the market has traded between above a 30p. Now, when you look at 25 to 30p, the market has traded 64% of the time in that range. And that's supposedly the most difficult time to sort of time the market. So how do you act in this period? The market, the rest 10% has been between 20 to 25. So when you look at the range between 20 and say 30, 35p, this is where is the market. So to ascertain and pinpoint a time when it is at peak is nearly impossible. The other point is the last 1 year, and it's a very classical example because a lot has happened in last year and a bulk of the equity wealth creation has come in the last 1 year. Now, when you look at it from a data perspective, if you were invested in the entire all the days of the year, you would have been, say, 46% up in your portfolio. Now, if you missed out just 10 days of that, and it's very easy to miss out 10 days, your returns would plummet to 22%. If you missed out just 20 days, it would give you 7.5% return approximately. Now, if you missed out just 30 days of that, you would go into a negative return journey. And if you missed out 40 days, in the same period, your returns would be minus 16.4%. See, this is how difficult it is to time the market. That's point number one. If you look at a static versus a dynamic asset allocation, this is just industry data. The blue part being the market, the deep blue shaded part, and that is how the market has risen up. The orange part is how the static allocation has remained invested in equity. And the dynamic asset allocation, as the markets start going up, have only reduced exposure. Hence, the difference in returns. Please understand, by structure, if somebody is coming into a dynamic asset allocation, he or she should be ready to the fact that it will invariably not catch the peak of the market. If you are a downside protection person, that is the fund to be. But if you are invested in equity, and invariably people invest in equity to catch the upside of the market, it is a static allocation which catches the upside of the market. Some people might say that, it comes at a certain volatility. When you look at the returns between the two, in a 1 year horizon, and I don't recommend a 1 year horizon as the right sort of benchmark. Of course, there is a gap in returns between the static, the orange being the static and the blue being the dynamic. But when you look at it from a 10-year horizon, the static allocation has given a 2% incremental return over the dynamic asset allocation. And you look at the standard deviation, clearly they have come, there's very little to sort of look at between the two. And then you come to the bottom part of the data, which is on a risk-adjusted return. Clearly, when you look at it on a long-term horizon, on a risk-adjusted basis also, the fully invested portfolio has given a justified return to the overall investor who stayed invested. When you look at the rolling returns, that is the hybrid versus dynamic, obviously the fund which remains invested sort of starts giving a much better return because the aggressive return, again, the 1 year return might be a little short-sighted, but when I look at the 3 year return, the BAF has or the dynamic asset allocation has given a better return sometimes on the max return, but from a median return, clearly, the hybrid returns have been 9.8 versus 9.06. But my really submission comes to the SIP investor, because when you look at mitigation of risk, it is done by the SIP investor, which invests over a period of time, hence catches the upside of the market and invariably catches the low of the market. And that is where is the biggest differentiator. The static allocation funds have outperformed the SIP returns of the dynamic asset allocation by 5% over a 5 year horizon. That is, the static allocation have given 16.02, and this is just industry data, while the dynamic asset allocation have given 11.27. So a risk mitigated approach, which is the SIP route, has clearly shown that the static allocation has always outperformed the dynamic asset allocation. Of course, the near-term returns are far more better than the longer ones, but the longer ones are the one which we normally speak of, because investment in equities or for a longer horizon. That is why, from a data perspective and the inability of anybody to time the market, the best way is to remain invested on your asset allocation, and hence the aggressive hybrid, which is 75-25 in nature, giving the 75% its own journey in the market. At the same time, when markets invariably go down, the debt side plays out with its 25%, with an effective rebalancing route on a yearly basis. On a return perspective, is a better proposition than the dynamic asset allocation.
Well, as the data points are showing, the discipline pays off, especially since, as you say, guessing the markets is tricky business, which is where the defined allocation that aggressive hybrid funds, for instance, build a use case versus dynamic asset allocation funds, which again try and time the market. Thank you so much for that analysis, Swarup. On that note, it's time to wrap up this conversation around hybrid funds and their value in a portfolio. I'd like to thank Swarup, Yasir and Arun for joining us and sharing their insights on the topic. And of course, thank you to our viewers for tuning in. This is Gautam Srinivasan signing off.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.